You're listening to the greatest multifamily investment advice show. My name is Adam Ross, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Kyle Ford, an exceptional guest and real estate investor and mortgage broker out of Kitchener, Ontario, whose career is focused on real estate investing, private lending, and more than 20 properties around Ontario. How are you, Kyle?
I'm doing well, Adam. How are you?
Thanks a lot for being us with today, and I appreciate taking the time.
Yeah, happy to be here and happy to get back and share my experiences.
Thanks a lot. Your experience on private lending side as a mortgage broker, I think, was an edge to scale your business. But can we start with what was the motivation to say I want to start real estate?
Yeah, so a little bit of a background. I've been in financial services now for almost a decade. It'll be 10 years in the next month or two here. I started off as an independent financial advisor. So I was working with major insurance companies, working in the traditional financial planning approach. As an independent financial advisor, that generally means you're working with a lot of people you know in the beginning, friends, family, people around you.
100%.
The first thing I saw with some of the most successful people I thought I knew at the time was their retirement plans weren't as concrete as I thought they were. They weren't doing as well as I thought they were. But those that were doing really well, it was because of their real estate holdings that were really propelling them and giving them a better financial outlook for their retirement. So as a wet behind the ears 23-year-old financial advisor, learning everything I need to know, it was eye-opening for me, and that was the first time I really saw real estate as, hey, this is something that is good for retirement planning. So from there, I did buy a couple rental properties. I bought a pre-construction condo and I bought a single family rental in Woodstock. And those were doing okay for me, but I was, stuck, as they say. I didn't think I could buy anything else. Like, that's all the money I had. That's what I was doing.
Maximum three
In March,
properties.
what's that?
Always you start with a bank, and bank tell you after first three properties you're stuck.
You're done. You're done. There's no more, right? And I was a financial advisor, so I thought I knew my stuff.
Yeah.
So in March 2015, there was one of those radio ads, HGTV's Superstar coming to your town. So I went to a real estate education program, got involved with that, and that allowed me to kind of see that there's more to real estate than just the traditional buy a property, rent it out, get a mortgage from the bank. So between 2015 and 2018 is when I really scaled and started growing. I had over a dozen properties by the time January 1st, 2018 hit. And I was, an interesting fact about myself is even the two properties that I bought before, neither one of them required a mortgage from me. One was pre-construction, and the other one I bought with my brother, and he got the mortgage.
Oh, okay.
And up until 2018, I didn't qualify for financing. I was self-employed. So even though the banks had already kind of cut us off, I didn't qualify on my own either. So what I had to do is I had to learn to do creative financing techniques. So joint ventures, vendor take back mortgages, and then private money. So in 2018, January 1st, 2018, it's a pretty significant date in the mortgage world. That was the day the stress test came out. That was the day that the mortgage world changed forever.
Yeah.
And a lot of brokers started running for the hills. I sold my financial planning business and started as an independent mortgage agent on that day. So I saw opportunity when people were running. I went at it. A story I like to tell everybody about that is that a lot of mortgage brokers like to talk about how easy things were before 2018. Well, I don't know how easy they were before 2018. I only know how they are now. So let's not talk about how it was easy back in the day, because that doesn't matter anymore. We only need to go with what we can do today. So in 2018, I became a mortgage agent, really kept scaling my portfolio, got into bigger multifamily.
What was the opportunity? You just said, what was the opportunity? You said that you find the opportunity where everyone was running. So what was the opportunity in your opinion?
The opportunity was everybody else was running.
Oh, okay. Yeah.
that was the opportunity. People were leaving the industry. People
Yeah,
were scared about mortgages.
correct,
The brokers were, some of them were throwing their hands up and saying, "Well, I can't help anymore."
correct.
So I figured there had to be a way to do it. There's still a way to do this. It's just not going to be as easy as it was before. But like I said, I didn't know how easy it was before. So
Correct.
I attacked it. I went at it, started building the mortgage business. Um, Started doing larger multifamily. I've gotten pretty heavily into the cottage space, as well as land development. We're building over 220 new construction homes and condos right now. I've built up the mortgage team as well, so I now have 5 agents producing under me. I try not to brag or boast, but I'm pretty proud. In 2021, I finished in the top 1% nationally of mortgage brokers at Mortgage Alliance. So, and really that success comes from the private lending side of the business.
Correct.
We focus on financing the deals that most banks and brokers can't do. And from an investor perspective, what that means is the BRRRR buildings, the ones with really low NOI in really rough condition that the banks don't generally want. Those are great deals for a private money lender. It's for if the investor is going to go in, increase the value of the property through strategic renovations, increase the NOI. Now it's a clear exit strategy to pay back the private lending. So that's a little bit about where I came from, what I did, and where I am today. So yeah, happy to share that.
I would like to open 2 subjects here. The first one, Kyle's investor and Kyle's private lending advisor. So we can start with your journey on multifamily and how private money was really a big help for you. And if we can touch base on one of the biggest deal you did so far, and we can break the numbers so we can talk about it.
Yeah. So how I got into multifamily, I mentioned in March 2015 is when I took the real estate course. And I won't, it doesn't matter which one I took. There's lots of great ones out there. The point is people need to get educated. They
100%.
need to learn about this stuff, and listening to podcasts like this is a great start.
Correct.
So that was the first time I really even like multifamily even dawned on me. Like I was looking for the sexier investments, a pre-construction condo. It's beautiful in a good area. Like multifamily just didn't even hit me. And then all of a sudden, they started talking about duplexes and triplexes and tenplexes, etc. And the interesting thing is there's something in your brain, and I forget what this stands for, but it's called your RIZ. And what that means is, when you buy a new car and all of a sudden you see that everybody's got the same car and you see it everywhere that car exists.
Correct.
Well, coming out of that course, it was like that for me. All of a sudden, I couldn't stop seeing apartment buildings and triplexes and they were everywhere. And I had never noticed them before. So that's when I started. I started with triplexes. Purpose-built red brick triplexes in Kitchener. At the time, the LRT was just being approved and starting. So I figured if I can buy close to that LRT line, I think I should do okay. Near public transit, near the hospitals, those key investment indicators. So I started buying them. And, I mentioned now I'm building, major construction, 220 new builds.
Where is this before?
It's actually like 230.
Where is this?
Those are in Hamilton, Ancaster, and Grand Bend.
Oh, okay. Okay.
So the interesting thing about this, though, is I am completely useless in construction. I cannot swing a hammer. Yeah, silky hands for sure. Yeah. I can't swing a hammer. I can't use a drill. I'm not construction oriented. So when I started buying these triplexes, we were buying clean patch paint. So things that just needed a coat of paint, a couple new light fixtures. Maybe we hire a flooring company, but like very basic stuff. And we were just cleaning them up, getting a little bit more rent, refinancing, that classic BRRRR. So I bought several of those. And then from there, I started, seeing the economies of scale of doing more at one time. So around that late 2018 mark, that's when I did my first big deal. There's a lot of social media content out there. It was a 10-plex that I bought in Cambridge, Ontario. It was 10 townhomes. I got that deal at the time for 1.3 million. So 130 per unit.
Yeah, not bad.
it was a great deal at the time.
Yeah.
But the NOI, the net operating income on that was awful. It was terrible.
The
It
cap
did
rate
not
was really low.
really low, and the income and the expenses, it was not professionally managed. The building was in rough shape, so no banks and lenders wanted to touch it. So the building was up for 1.5. I got a call from a realtor I work with. He said they'll take 1.3 if you can get it done quick. So I went in and I
How quick?
looked at it. So I had 2 weeks condition. 2 weeks condition.
Who was
45
able
days.
to who was able to close for you for in 2 weeks?
So I had 2 weeks conditions.
Yeah.
So 2 weeks of conditions and a 45-day close.
Oh,
So
okay.
it's closing in 45 days. But just to understand, commercial financing is generally 30-day condition minimum,
Yes. Yeah.
just on the conditions, and then another 60 to 90 days to close.
Correct.
So they wanted it me firmed up in 2 weeks. I had called one of the private lenders that I had just paid back on a flip that I was doing and said, I have this deal that's coming. I have no money for down payment. I have no money for renovations, but I can get this building for a good deal, and I think it's worth a lot more when I'm done. So I actually, and the private lender Googled the property. They agreed with me that they thought it was good. I had a good track record with them. They ended up lending me on that specific deal 140% loan to value. So they lent me
140. Wow.
140% loan to value. I paid 12% interest on that money, plus a 10% lender fee.
So 22%. Wow.
22% on that money, 140% loan.
140% to like 1.3. You're talking about 1.7 million?
More than that. It was more like 2 million.
Wow. Okay. What was the security on this? Like on
first,
like the security.
First position mortgage plus a construction holdback. So they were holding back the money for construction.
Okay.
And my personal guarantee. And at that point I had over a dozen properties. So I had other assets at that point. I had a good track record with them.
Correct.
So they were in first position. Plus, they're holding back the construction money until I started doing the work.
I'm just when you're saying first position, all of this properties you had, it was already under mortgage or just it was cash?
Yeah. So they were first position on the 10-plex.
Oh, okay.
And all my other so they were first position on the 10-plex.
Correct.
And then holding back the construction draw. And then, yes, all my other properties had first mortgages on them.
Yeah.
But there was equity behind that. So my personal guarantee actually meant something.
So these are second position on the other properties or just on the loan to value part?
LTV. They're just first position on the 10-plex.
Oh, okay.
And they weren't secured on anything else.
That's not bad. So if
it was a great deal. But the total rate and fee equaled 22%. And it was at the time, it was very scary for me. I never borrowed that much money. I never paid that much in interest and fees. But I knew that the deal was good. And I knew that my numbers were concrete and numbers made sense. So I'll give you the more brief version of this. I ended up being into that building with taxes, interest, fees, renovations, approximately $2.7 million.
Okay.
I had predicted that the value of the building would be, at the absolute worst case, $3 million. In my opinion, the best case.
At which cap rate you did this?
So I have to. I don't remember. I did it at. So I did 3 cap rates, and I might get this wrong here because I'm going off memory. But at 3 million was a 5% cap.
Oh, okay.
At 3.4 million was a 4.5% cap.
Okay.
And at 3.8 million was a 4 cap.
4.5 will be more accurate with Cambridge. You said Cambridge, correct?
Yep.
Yeah, Cambridge is okay. It was 4.5.
Yep. So like I said, the worst case, I was thinking I was going to get a 5 cap on it, which was 3 million.
Yeah.
Second, next,
Next
my
case.
prediction was
3.4.
3.4, and then 3.8 was my top end.
So how long it take how long it take to finalize the project?
It was we closed in January, and we were fully tenanted by April the following year. So about 15 months.
Not bad. Great. 10 units?
Not bad.
Yeah.
10 units.
And it was
So,
cash for keys?
In that specific deal, we did an N13 construction notice,
Oh, okay. N13, okay.
and then we negotiated cash for keys for people to sign off to not return.
Oh, okay.
So, just so it's said, this is something that can be sensitive in today's world. I'm not actively in the business of cash for keys, but I am. It is part of the business, and it's something that we need to do sometimes. When I do these deals, I only do it on buildings that are completely dilapidated. This
Okay.
building was disgusting. The previous owner was a slum lord.
Yeah.
The building needed major structural work, major plumbing, sewage,
Huh.
everything, electrical, everything. So
Anything about the environmental on this area?
environmental was clean. Environmental was clean.
Oh, okay.
So we were okay there.
Yeah, okay.
So when it was all said and done, I mentioned the range I predicted was between 3 and 3.8. I
Yes.
got an appraisal at 3.5 million. So right
Great.
in the middle of it all.
So you got
So,
almost 800K refinance.
So I had $800,000 in equity. And my
Correct.
plan
Yeah,
was to refi.
correct.
The challenge that I ran into in the next year that it took me to refi. So sorry, what I did is I took a MIC for lower money when it was done. So instead of being at 12% interest anymore, I dropped the rate down to 7. So I got a MIC for a year.
So who was giving you the 7? Again, private lending or CHMC?
So that's what's called a MIC, which is a mortgage investment corporation.
Oh, okay.
So that's like an institutionalized private lender.
Okay.
So basically, I was with an individual guy who lent me money at 12% interest plus the 10% fee,
22.
but the money was only at 12% at the time.
Yeah.
So and then when the building was done, I got a MIC to pay him out, so it dropped to 7% interest. Well, I tried to go through CMHC.
Oh, okay. Okay.
So that was the plan. I drop it from 12 to 7 because CMHC takes a while to get.
So 7 only,
Well-
or 7 with extra fees, or the total was
There was
7%?
a 2% fee at the time.
Not
2%
bad. So
fee.
from 22 to 9% is great. Great deal for you.
That's right.
Yeah.
That's right. So this is where I learned a lot about CMHC. And what I see from time and time again from clients, by the letter of the law, CMHC is a great program. But when you are doing aggressive burrs like this, it can be very, very difficult to get the loan to value that you want. So for example, even though my income supported it, CMHC was only willing to offer me a $2 million mortgage at the time.
Because of the appraisal?
And not because of the appraisal, because of what they said was the income and expenses.
Okay, so they look on the market value of the rent on their calculation, not yours, not the actual
right.
market rent.
Because I didn't have a 3-year rent roll at new market rents,
Oh,
they were saying I was getting between $1,850 and $2,050 a month. CMHC was using like $1,400 to $1,600 as my rents.
oh, since the cap rate is dropped, then you cannot finance more than this. Okay.
You can finance. So the CMHC and this was at the time where CMHC was very, very slow. Like this was in the beginning of around
2020?
COVID. Yeah, it was 2020. It was right around COVID.
Okay. No one is answering anyone. Correct.
That's right. So it took forever. Then we had a credit union come in, and we basically declined CMHC because at $2 million it just didn't make any sense.
Yeah, you're gonna lose money.
We're going to lose money.
Yeah.
No, we're not going to lose money. We just would have had to carry such a large second that it wasn't profitable.
So for people like hearing about CMHC loan, it's just because it's the residential and commercial differences. If you can elaborate a little bit the differences and the benefit on CMHC loan on the commercial side, because everyone when he hears CMHC, he say, okay, it's a insured mortgage. No, it's different on commercial, I think.
Yeah. So let's talk about what CMHC is in residential for a second.
Yeah.
CMHC is default insurance that the Canadian Mortgage and Housing Corporation, CMHC, requires you to have if you are putting less than 20% down. So if you're buying a house with 5, 10, or 15% down, you are required to have this insurance.
Which is insured
This
mortgage.
it insures the mortgage for the lender to make sure if you default, the lender gets their money back.
Correct.
So the idea of this is to protect the Canadian housing market. Our banks are safe. We have this insurance premium. So CMHC is it's a requirement, and when it comes to the residential side, some people are like, "Well, I don't want to buy a house. I want to save for 20%." I would argue that's probably not a good idea. Put the less money down, get into the house now, and the CMHC premium doesn't actually come out of your pocket. It gets tacked onto the mortgage.
Correct. Especially that you want to go with more leverage to take more money from the bank.
More leverage. That's exactly right. So that's CMHC for the residential side. Less than 20%, you have to have it. On the commercial side, CMHC is an option. It's not required.
Correct.
However, by having what's called a CMHC certificate of insurance, that means you can get longer amortizations, lower interest rates, and potentially higher loan to value. So
usually 85%.
They can do up to 85. They have some new construction products that are like 95%. It's pretty crazy.
Wow.
I don't have a lot of experience in those products, but they do exist. So the CMHC program on the commercial side was really what everybody wanted. Even though it wasn't required, if you could get CMHC, when you looked at what you got, 85% loan to value, 40-year AM, the lowest of low interest rates, fixed for 5 years. And I'm a big variable guy on the residential side, but if you can get a good commercial fixed rate, that's probably not a bad idea. So it was really the gold standard of product. But increasingly, more often, I am finding investors not getting the terms that they are expecting after months of providing paperwork and detail to CMHC. Their certificate is coming in much lower, which is not giving clients the loan to value they're looking for. So my simple advice to investors is look at CMHC. Like don't rule out CMHC. Paying the premium is worth it if you can get the terms you want, but make sure that you are looking at other factors like loan to value, because putting all this money down for CMHC doesn't make a lot of sense in a lot of cases. You're often better off using a credit union, using a bank, and getting a higher loan to value at a little bit higher rate. So that's the advice I'll give around the CMHC stuff. Definitely look at it. But to tie it back to that story there, we looked at CMHC, couldn't get it. We looked at a credit union. They were same thing because we didn't have 3-year history. They were looking at like 2.3, 2.4 million. They still didn't, which was about 65% loan to value on our appraisal, which we were considering taking until I mentioned to a realtor that has a pretty good exclusive list. I said, why don't you shop this exclusively for me? See what you can get. And we got an offer for $4 million. No fuss, no muss. It was a 20-day condition, 2-month closing, qualified buyers, and we made the decision to sell the property.
Really?
Yeah. So based on that, we were able to net a $1.2 million profit in just over 2 years into the deal, using none of our own money, all private financing, and pull our cash out and move it into new, better performing projects.
100%. So the previous plan was buy and hold and refinance, but because of the refinance and the higher fee, you decided to let go and sell the property.
Just to be clear, the refinance I didn't let go because it was a higher fee. It's because I didn't get the loan to value that I wanted.
Okay.
I had too much money left in the deal.
Yeah.
So I couldn't get the loan to value, which is why I decided to walk away. And just so it's said, Adam, I still consider myself a buy and hold investor. I am a buy and hold investor, but everything's for sale. Everything's for sale.
Correct. And you use the money. You use the money for development now. So you're using the cash.
The money didn't buy, doesn't buy clothes, trips, and boats. It goes into. I did buy a boat, but that's not with that money. The money gets reinvested into better performing projects.
Correct.
And things that I can force the value up on. So I have 2 other 10 plexes on the go right now in Kitchener. And both deals, I would love and am absolutely intending on keeping them at the end of it. But they will be shopped exclusively. And if somebody wants to pay me a ridiculous premium to sell it at
Then why
top
not?
market value,
Yeah.
then why not?
Yeah,
So
correct, correct. So how many properties under management now?
uh,
Or doors, whatever you like.
so it depends how you count it. So it's about 50 doors in the long-term hold,
Hmm.
29 properties, and then 230 new pins, new development,
Yeah,
new.
correct. Yeah. Was
So
so this was a private like raising capital with GPLP, like as a GPLP, or what was the deal with the 220?
yeah, so they're two separate structures.
Hmm.
The one is just a simple corp. That's the 116 units in Hamilton.
Hmm.
So I have a working partner who's boots on the ground. We have a financial contributor. Boots on the ground gets 33%. Our financial contributor gets 33%, and I'm 33% as well.
So
So
only three entity.
what's that? Pardon me?
Only three entity here. So the
Yeah,
working.
3 people, simple deal, simple corporation. We assembled 6 parcels and we're assembling it. We're just resubmitted for site plan approval today.
Hmm.
We have gone back and forth, and we're very confident with our new submission that we're going to get it. Site plan. That's 116 units, simple corp. And one investor, a client of mine who I've worked with for a lot of years. Our other development is in Ancaster, which is a 100-unit subdivision.
Okay.
And that one is a GPLP structure. So I work, I have a pretty significant Rolodex over the years. So I've got about 10 people in that one, all accredited, friends and family, business associate. Neither one of these deals I marketed at all. Like, they weren't sent out to the public. These are private offerings in my exclusive network kind of thing.
Okay.
And my advice to people is, if you're getting into development and getting into this stuff, you need to be very careful of what you're doing. Especially if you're going to market to the public and the securities, you need to make sure that you are in compliance and set up properly. I'm blessed to have a great Rolodex of people that I don't need to market to the public for these. I can work in my private network to fund it.
Just for the audiences, I think Kyle is focusing on the laws for the security laws for accredited or qualified investors, and how to present the deal to the qualified investor. Because if you don't have an actual relationship, you just cannot say he's my friend, he's giving me 200,000, or he's making 200K per year, I'm gonna get from him the money, and he's gonna be my partner. You have to have certain certain relationship to able to present the deal. Hope that I'm getting it right.
Yeah, that's great, Adam. And for years the real estate industry was the wild west. And I'm not saying I wasn't involved in the craziness, but it was crazy, the things that we're seeing. Those days are over. You need to get, and I don't know if I can say this on this here, but I'm going to say it anyways. You need to get your shit together if you're raising money.
Correct.
You need to make sure you are compliant, you are professional, you're doing things the way they need to be done, because the securities commissions are watching, and you need to make sure that you're on the up and up and you're doing things the right way. Hire a lawyer, have your stuff reviewed. Pay a $900 an hour securities lawyer to look at your stuff and make sure you're in compliance, because it is not worth not being compliant.
So who's your security lawyer now?
So I work with I don't know if I should be saying it on here. I don't know if I'm supposed to publicly advertise him, but I work with a major firm, security lawyer there.
Okay.
If somebody is ever looking to reach out and talk about things or talk about development, I'm always happy to have a call, and I would share that name individually. I just don't know if I should be publicly
100%.
saying who they are.
100%. Okay, so my next question will be, you mentioned that your starting point was after the seminar. So do you have an influential mentor so far? Are you like dealing with any mentors now? you like to follow up with, or not anymore?
So do I like the what?
To follow up with mentor, do you have a mentor so far in your
Yeah,
career? Uh,
yeah. So I personally do have an individual mentor. It's not somebody that is hired or anything. It's somebody that I built a friendship with, and it's we're just friends now. And it's funny. I think I actually help him out a little bit now too. I think it's he. I give him credit for everything that I have, but I think he would admit that even in my as his mentee, I'm now adding some value to him and showing him some different ways of thinking and ideas. So I absolutely do have somebody. In terms of for our listeners here today and everyone out there, there's so many great ones out there, and there's many great programs. I would say if you're investing in Canada, especially as a newbie, find a Canadian mentor.
hmm,
I don't think you need. I don't think you want a U.S. one to start. But once you get to a certain point, it doesn't matter where they're from. The theories and principles are the same. But in the very beginning, if you want to invest in Canada, you should probably get a Canadian one. If you want to invest in the US, you should probably get a US one. But there's so many great programs. Interview them. Don't let them just sell you on the program. Interview them. Ask them questions. Am I working with you or am I working with your team? It's okay if you're working with somebody's team, but you should know that up front. Okay, if I'm working with your team, can I meet them? Can I meet the person that I'm going to work with,
hmm.
so I know who I'm talking with on a basis?
Good one.
Just because
So
just
many
because
of
someone's
them, as you said, yeah, they telling you that yeah, I'm gonna be your coach, but eventually you're dealing with his assistant or his team members. Like, good point, really. Yeah.
yeah, and it's okay if you're dealing with the team. Like sometimes that's better. If your mentor is really really busy and they have a good right hand person that can help you, maybe that's even better. But just know up front. And just because a mentor was good for you or good for Adam or good for Kyle or good for somebody else doesn't mean they're going to be good for you.
100%.
So make sure interview a couple, talk to a couple, join the Facebook groups, get involved with multiple things and find someone who aligns with you. You need a mentor to show you the next level, but you also need a group in the same position that you're in today.
Hmm.
And what that means is if you're buying your first sixplex and your mentor has 100 units, that's great. You need that mentor to show you where to go and hold the map up and take you there. But you also need a couple buddies that are also buying their first sixplexes too. So you guys can scrape your knees together,
Yeah.
but your mentor can show you where to go.
100%.
So your mentor is your guide, but you also, if you have a buddy who just bought his sixplex too, he's the one who's still sourcing, trying to find a better deal on trades and construction and trying to find a new software to help, manage the property and, have some people that are in the trenches with you and somebody who's showing you the way.
100%. 100%. So for raising capital, maybe a couple of action item for the audiences when you started to raise capital, because on this business, the core thing is and in my opinion, is to raise capital and networking. So what was difficulties you faced to start to raise capital?
So I don't know if I ever specifically was raising capital.
Really?
I was attracting money.
Okay.
So I wasn't actively seeking and chasing and trying to find capital in a traditional sense. I was showing people what I was doing, how I was doing it. And in the beginning, so the first couple of deals I did with friends and family. So I did it with parents, brothers, sisters. They could get a mortgage. We bought a triplex together. I did the work. We bought it. So I suppose I raised capital from my family to partner on those deals. But I wasn't asking them for money. I was showing them an opportunity. I said, I have the ability to manage this property, to make it cash flow, and this is how I think it's going to grow in the next 5 years. But I'm looking, if you can put in the money, I can make all this happen. So I wasn't asking them for money. I was showing them an opportunity for us to earn together.
An actual
So
partnership. You're not
an
as
actual,
yeah.
yeah, an actual partnership. So from there, I did several of those, and what I got a call right when I became. So I didn't use a lot of private money until 2017. It was all JVs.
Hmm.
So I was JVing everything. And then I got a call from my lawyer who had closed all these
Just
transactions.
for this part, when you're saying GV, you do the work, someone is qualifying for the mortgage and brings the fund.
Yeah, and I was predominant, and all of those JVs, every single one was with family.
Hmm.
And just so it said, I did not come from a wealthy family. I had my mom and my dad were both separated. They both had an average Canadian house and an average Canadian job. We remortgaged their houses to pull out the equity to buy rental properties. Like this wasn't like, we had a silver spoon money kicking around everywhere. I'm the youngest of 5 siblings.
Okay.
My sister and brother were both 5 years older than me. They both had houses and jobs. So we remortgaged their houses, put down payments down. So that's how I did my first 4 or 5 deals. So like I said, this was, and it wasn't like there was, I was, running seminars to raise money here. I was just finding deals and talking to the people close to me about an opportunity that we could do together.
So
And this is a partnership.
you started to look for deals, bring the deal under contract, and then look if you can close on it or not. Correct?
Yes and no. Here's what I was doing. I was showing them at that point, there was triplexes all over Kitchener.
Correct.
So I was running the numbers and showing them, like, look, these numbers work.
You're still focusing on the single family home.
Triplex.
Yeah,
These were
triplex.
triplex.
Yeah, I'm sorry. Yeah.
So I was showing them the numbers work on these.
Yeah.
And then what I said, if I go out and I find a deal, let's put it, can you put up the money and get the mortgage?
Correct.
I'll do everything else. Can you put up the money and get the mortgage? So then what we did is I went out and found the deal. We put the offer in with them right in the beginning. They bought the house and we partnered it.
Correct.
So there's not right or right. This was specific. I was working with families, so it's maybe a little bit different than how the other dynamic of how other people would do it. Most partners, I would say now, you need to go out and get the deal under contract and then take it to partners to show it to them.
Correct.
I was maybe doing it a little bit different at the time.
Yeah.
So from there, what happened was I used the same lawyer to do all these deals. And he was kind of, excited about what I was doing. He was an older guy. And he's like this, at the time I was 25, 26, or I guess 2017, I was 27, and I had about a dozen properties. So he thought that was pretty cool. And he said to me, when you're looking for some private money, some high interest money to do real estate, let me know. I'll happy to help. And my initial response was, no, I'm never going to need that. I'm never going to need that because I do BRRRR. I BRRRR all my properties and we pull our down payment out and we reuse the same money and we keep getting A-rate financing and we don't need private money. And he smiled and he said, okay, call me when you're ready. And it was about 6 months later when we were ready.
Can you please give me more? Not yeah.
Yeah. So he basically, he saw it happening in the portfolio and he saw it happening not in a bad way, but he could see that I didn't know I was about to get stuck, but he could see I was.
Correct.
So that's when I got connected with him and he started lending me private money. About 2 years later, I got another call from him and I wasn't brokering really private money. The first year being a broker, I wasn't really brokering private money. It was just conventional deals. So about the start of year 2, early January, 2019, I get a call from my lawyer and he says, so things are going really well with lending you money and really happy with how that's going. I want you to start telling people that you have private money. I want you to bring me more people. I got more money to lend. So I did. I didn't know any better. I just started telling everyone I know that, hey, I have access to private money. If you need private money for your real estate deal, I can get it. I can help.
The cycle started.
And yeah, I'll tell you, when you start telling people that you have private money, your phone starts ringing.
100%.
So that's how I did that. And then from there, my clients were seeing that I was doing private money, and they're like, hey, I want to lend private money. You're lending money at 10 or 12%. I have equity in my HELOC. I have equity here. So I can start lending. And when you start consistently getting people 10 to 12% on first and second mortgages secured on real estate with a good track record of payback, your phone progressively starts ringing and aggressively going. And before you know it, you aren't raising capital, you're attracting money left, right, and center. And people want to give you money to either lend on a mortgage or invest in an equity deal or be a part of your business and your circle and around that. So that's my story. That's how I did it. I'm not saying it's going to work for everybody.
Yeah.
But
I have
it
a
is.
question here.
Yeah.
You mentioned that you dealt with two different private lendings, the regulated one and your lawyer, for example. So what was the deal with actual private lending money with the rules of the lender itself? Because you're dealing with individuals here, not a regulated one. You mentioned that on the first one was 22%, the second was 9. I think the 9 one was the regulated one, correct?
So I don't want to use the term regulated. The term is institutionalized.
Oh, yeah, correct. MEC. Yeah,
So
correct.
institutional, but all private lending is regulated.
100%.
So
Yeah.
all the difference between, so there's 4 tiers of lending. There's the A lenders and
Correct.
credit unions, monoline lenders, the A rates. Then there's B lenders.
Correct.
So B lenders are still institutions and companies, but they're not bound by the Banking Act.
Correct.
So they can lend money differently. So instead of 3% with a big red bank or a big green bank, you're going to get 5% with a B lender.
Correct.
So they're still a bank, but they're just not a Charter A regulated bank.
I think like Tangerine, Trust Home, and so on.
Well, Tangerine would still be an A lender. That would still be considered an A lender.
Trust
so a
Home.
B lender would be like Home Trust.
Yeah, Home Trust.
Home Trust would be a B lender.
Yeah.
Equitable Bank, NPX. For some lenders have a B division as well. So that's Community Trust is another one on the B side.
Yeah.
Then from there, there's private money. But there's 2 tiers of private money. There's C lenders, which are called MICs, Mortgage Investment Corporation, which means it's institutionalized. So they have a board of directors, they have trustees, they have lending guidelines, they have overarching guidelines and things that they're way more flexible than A or B lenders, but they still have to, fit in a box of some sort.
Correct.
What the final tier is still regulated lending. There's still rules you have to follow, but it's individuals.
Correct.
It's Bob, it's Mary, it's Adam, it's Kyle. Bob can do whatever the heck he wants with his money as long as it's within a general regulation. If he says to you, I don't want to lend you money, but under those terms, but I'll lend it to Kyle, that's okay. That's not discriminatory. That's not anything.
100%.
He's an individual lending his money.
Correct.
So that's the difference between institutionalized private and individual private.
Yeah.
So an institutionalized is still a company with rules and guidelines that they have to follow as an organization. A private guy, if he's got the money and he wants to lend it at 120% loan to value on something, and he's happy with the terms and the security, he's allowed to do that. You're allowed to do whatever. You're allowed to do that. So
I think, and your best bet anyway as a starting point, if you don't have a lot of track record, like 5-6 properties, I think D-lend, like this kind of lending is going to be your best bet, because you're going to need for construction, you're going to need for your actual closing. So I think, as you said, you need to rely on all of this type of funding, not only one type. And you mentioned that you had this issue already with A and B lenders, that you're in already in a, you cannot move forward, you cannot scale. You need to move to another avenue to find money to close the deals.
That's right. And here's what I say: everybody wants an A lender. Of course, we want an A lender.
Yeah.
But what's more important is you do the best deal you can. And an example of my 10plex is I started with a D lender or a private lender, whatever you want to call it.
Correct.
I started there, and I was trying to go to A, but I couldn't get to A right away. I thought I could still get there. So I went to C. So I moved up to reduce my cost.
Yeah.
And I was trying to go to A, and I was looking at B, and I couldn't get the terms I wanted, so I sold the property.
Correct.
But it's not that I'm still a buy and hold investor. I didn't want to sell the property because I didn't like the property. I just couldn't get the financing terms that were suitable to me from a rate of return perspective.
Correct.
So my rate of return was no longer in line with my standards. And I got an offer for the property that was, I believe, above market at the time.
Correct.
So I liquidated the asset and moved it to a better performing vehicle.
When you mention it was not up to your standard, you mean cash, like cash flow, or it's just you needed the money to use it for another? Because I think it was a bear strategy. So you needed to liquidate the money anyway to move to another deal. So when you said this was not meeting your standard, it's only the cash flow, or because you want to scale and you don't want to just leave your money stuck on this deal so you can move on to another deal?
It wasn't meeting my standard from a return on equity perspective.
Okay. Return on investment per year, you mean?
No, yeah, return on equity, not in, so return on the equity in the deal.
Okay. Yeah.
Okay. So here's what I mean by that. My rate of return in 2 years was what? It was infinite. I didn't put any money in this deal and I created $1.2 million in equity.
Correct. 100%.
So my return on investment in year 2, in the first 2 years, was infinite rate of return.
100%.
If you use the traditional cash flow return on investment calculation based on what it looked like at a $3.5 million value and a $2.7 million mortgage, the return was like 28% when you factor in principal recapture, 3% interest, and cash flow. 28% is okay.
That's
but
great.
the return on development, new construction, and a new burr is like 100%, 200%. When you're creating money out of no money, your returns are in the hundreds, not in the 20 to 30%.
100%.
So it's not 28% is a great rate of return.
Yeah.
But if I could move that money into a development deal, which could now return me at hundreds, 200, 300%, because I'm creating new supply, I'm creating new equity. 28% is low
compared to the 100% and super 100%.
Compared to 100%, right?
Yeah,
and I'm not.
100%.
There's going to be a time in my life. I'm 32. I just turned 32 in March. So there's going to be a time in my life where I'm going to slow down. And if I could sit there and get 28% on all my apartment buildings, I'm going to be a happy man. But right now in my life, in my cycle, where I'm at, I got a couple more years left in me that I want to hit the home runs. I want to hit the 100, 200 infinite returns. So when I have $1 million sitting there returning at 28% and it's really not liquid, I can't refi it. The cash flow is minimal and the appreciation is just staying in the building because I can't pull it out. Then the 28%, that return on equity is low.
100%. Just a final question. If you can define what is your strengths and like your superpower. Like you've been doing a lot on the last 6-7 years. So what you can say your strengths so far?
A lot of that is around my mindset, and I trust the numbers, and I have a handful of properties that maybe I am a little bit emotional. They're cottages. I don't want to sell them. But I trust my numbers. I trust my gut. I follow the numbers, and I stick to my standards. So I don't do small deals anymore. I don't do deals that aren't 7-figure profits. I value my time. I have amazing people that work for me that support me and do some of the day-to-day work. And I'm getting better at delegating. It's hard. Anyone who tells you that delegating everything is easy is lying. It's hard as a business owner to move in that position and start handing your babies over to people. But I'm getting better at that. But I talk to many investors and experienced investors and less experienced investors, and they say all the time when they're talking to me, the answer to the question when you say it is just so obvious. because I cut through the bullshit. The return on equity of that 10plex was low. So I sold it. Well, aren't you a buy and hold investor? Yeah, but the return on equity was low, so you have to sell it. And everybody wants to find a million reasons. Well, then you're a flipper. No, I'm not a flipper. I'm still buy and hold. The return on the equity for my buy and hold was too low, so I'm moving it into another buy and hold investment that has a higher yield. If the return on that becomes too low, then I move it into the next one. That still makes me a buy and hold investor. I talked to a client. So I talked to my team about this yesterday. I'm a firm believer that the HELOC is dying. The HELOC is a dying tool. You should be doing cash out refis. But without getting too far down that rabbit hole on this call, one of the agents on my team goes, well, so when I like my HELOC because I renovate the property, and then when I'm waiting for my next deal, I put it back on the HELOC and I'm not paying any interest on it. And then I use it for renovation. And then when the renovation's over and that property's sold, I put it back and I'm not paying any interest on it. And then, so what you're saying, Kyle, means I have to pay interest on the money when I'm not using it. And I looked at him and I said, dead in the face. I said, yes, absolutely. He goes, well, that doesn't make any sense. It's costing me money and interest. I said, you don't have a money and interest problem. You have a deal flow problem. You don't have enough deals that you have to put the money back on your HELOC in between deals. So you don't have a paying interest on a HELOC problem. You have a deal flow problem. You don't have enough deals that you have to keep putting the money back, not out to work. And he looked at me, he's like, well, shit.
The obvious reason. Yeah.
It's obvious you have a deal flow problem. So let's not focus, and Grant Cardone talks about top line sales. Yeah. Let's not focus on let's stop tripping over nickels and start making dollars. Now we need to watch our margins and watch our bottom line, making sure that our business is efficient and practical and all those things. But we're talking about saving a quarter point on interest here to have money downtime between HELOCs. Well, maybe we just need to increase our marketing to get our deal flow up, to make sure that we have consistent deal flows so our money is always out for work and we can take advantage of a cash out refi, which is a better mortgage product than a HELOC. So that if you ask my superpower, my strength, it's around mindset. It's cold to me. Numbers are the numbers. Numbers don't lie. People do. And you just trust your numbers and go with the numbers. And if you're trying to find ways to save dollars in interest, you probably have an issue in your deal. You're not finding deals that support the high interest. I'll give you one more here. There's a finite amount of money available at 2%. So there's only so much money available through the banks at 2 or 3%. You can only get so much of that. It's really hard to qualify. There's infinite money available at 13%.
100%.
If you're willing to pay 13%, you can get as much money as you need to do real estate. So stop trying to find deals that only work at 2 or 3% and start to find deals that only work at 13%. And you never need to worry about money. You never need to worry about deal flow. And you can consistently increase and grow and scale your portfolio.
Because your goal is not the grape, that your goal is to have a bigger share on the watermelon. So what is the benefit of having a grape and a stock? Yeah, 100%.
That's right. That's right.
Biggest mistake?
Not buying enough 5 years ago. Some of the deals that I walked away over $20,000 are worth like $500,000 more now. You're right. So, but at the time I'll call it, that's not a mistake, because what I did is I trusted my numbers at the time and I didn't overpay at the time. So in the grand scheme of things, should I have bought more? Yeah, probably, but it is what it is. Another pretty big mistake is I gave up too much equity on deals. I shouldn't have done so many JVs. I should have did more private lending and kept the equity. I won't call that a massive mistake, but in hindsight, it's cost a lot of money. I don't live in the past. I don't have regrets, but there's some deals that I should have just done on my own with private money and not. I was being cheap. I wanted a cheap mortgage, so I took a partner for 50% equity to get a cheap mortgage. But I should have just done the deal on my own at 13% and kept 100% of the equity. I would have netted out way farther ahead.
But
So
eventually, you said in some cases, if you not don't have enough portfolio to support the second position, you're gonna need someone to support you
yeah,
on the beginning, at least.
yeah. So like I said, I'm not crying poor over it. You
Yeah,
know,
yeah,
we did okay still.
yeah.
But yeah, so that would be another. And you know, most recently, and I heard it was just the other day on like a Instagram reel or a TikTok or something silly. Um, and it's something that I took to heart, and I'm really focusing on it right now, is separating my life goals and my business goals. My business is my life. I have sacrificed personal relationships. I have, sacrificed my own health at times. Got into arguments with my wife over stresses of the business that I shouldn't have.
Hmm.
And the money isn't everything. It's kind of up there with oxygen, but it's not everything. And making sure that I separate my business goals from my life goals. I have he's almost 2. I don't want to miss a single sporting event. I want to pick him up and drop him off at school.
Really good one.
I want to play ball with them and hockey with them and golf with them, and I want to be there for those moments. And those life goals are super important to me. And my business will be fine and successful. I can stop now and never work again if I really want to. But I still have business goals and business aspirations, but I can't sacrifice my life goals anymore to meet those business goals.
I like this
So,
ending. Yeah, you have to have some sort of balance on your life, but you have time anyway. He's 2 years old, correct?
yeah, he's 2 years old. I'm 32. We got time.
Yeah.
And I'll say that as well. I'm going to talk out of both sides of my mouth a little bit on that. If you're serious about starting and you're serious and you don't have anything and you're starting from scratch and you want to be big, you 2 to 4 years, it needs to be all about your business.
100%.
You have to sacrifice to make it happen.
Have
But
this
you need to be
commitment.
cognizant.
Yeah.
The commitment, right?
Yeah.
But that doesn't mean you can't take an hour out of every night and make sure you spend time with your little ones. Take your wife out on a nice date. Get up early and work out. Go for a walk with your dog. Do something to take care of your health. So just little things that you got to have some balance. So
100%. My final question will be how our listener can follow your success.
yeah, so it's Kyle Ford Mortgages on Instagram. So Google search me up there. info@kylefordmortgages.com is my email address. That's my admin's email address. I'm happy to do 15 minutes with anybody to talk to them and just get them started. Beyond that, if you're looking for help in the business, I have a mortgage team. So you get me as well, but I'll have an agent on the team that's helping and dealing with the day-to-day. We can help with private money. We can help with conventional mortgages. We can help with commercial, whatever you need. If you're a private lender and you're looking to lend money on real estate deals, we can help there. There's some qualifications and credentials you got to go through to be involved with us. But predominantly, if you're an accredited investor, you're able to lend. And yeah, from there, I got a YouTube channel that I'm hoping to launch soon. I don't have a name for it yet, so maybe you can think of something for me, Adam. Or if any listeners want to throw an idea out there.
100%.
I'm thinking money with Kyle right now, but I don't know if that's going to stick. So that's me. That's how you get a hold of me. And like I said, I'm willing to give anyone 15 minutes of my time to connect and get them started and give them a little bit of words of wisdom. From there, if you're looking for more help, I'll have the team take care of you.
Thanks a lot. Thanks a lot for your time today, and we're really happy to have you today. And I hope that we can bring you again to the show.
Amazing. Thanks, Adam.
Thanks a lot.